Howdy, Jacob here. Today we're looking at Electronic Arts. This is in the entertainment industry, 38.5 billion market cap on 37.6 billion enterprise value. They develop, market, publish, and deliver games, content, services for game consoles. I'm sure if you've ever played an EA Sports game, you got the classic EA Sports. It's in the game. Definitely not good at that. So let's continue. 4.5 billion market cap in 2015 to 7.6 billion in 2024. Not bad growth, not huge growth. Gross margin has improved pretty steadily from 68% in 2015 to 77% in the most recent year. And then operating margin relatively flat. But 20% is a pretty good operating margin right there. They have recently started to pay a dividend. It is a 0.5% dividend yield, so it's nothing substantial. Return on invested capital has dampened down a little bit, but is still pretty solid. Low double digit, maybe high single digit. Not terrible. Balance sheet has over $3 billion in cash-like products with 1.9 billion long-term debt, no short-term debt. So pretty healthy balance sheet. The cash flow statement has very little capex in relation to their cash from operations, and so heavy production of free cash flow. And the use of their cash flow is acquisitions when it comes around, a dividend that pays out maybe 10 to 15%, and then share repurchases with well over 50% of capital allocation. I think that's enough to get me going here. So on the revenue growth side, I don't think we'll be seeing anything crazy growth. It's been around for a while, but I think they do have some dominance here. I don't think it's the most dominance ever, but I think that 5% a year seems pretty reasonable to me. I do think they deserve a premium above the market based on decent margins, good return on invested capital, and the business that they are. For margins here, I like that free cash flow is a little bit higher, even though the last 3 years have been a little bit lower. I don't like that as much, but I think I'd be comfortable with maybe a 22% on the margin side with share repurchases, 1%, just under 400 million. So with stock-based compensation, like 1.3 million for 2%, I think that's pretty reasonable to me. Dividend, don't want to increase that too much. What have they done in the past? It's too short, so I'll keep that the same. And we're saying it needs to fall 58% before you get the return we're looking for here. So this is one of those companies where I do think there is a little bit of dominance. I do think they have a little bit of power in the market, in the industry that they're in. And they have some power above competitors. But again, almost everything is the price you pay for it from a present value, free cash flow, and earnings standpoint. For me, does still look a bit expensive. So hope you enjoy the video. Grace.